All right, let's go ahead. Let's bring him on. Welcome back, Ben. How we doing?
Hey, we're doing great. Thanks for having me again.
Of course, that's what it's all about. Like we've spoken on, of course, social media. One of the things that we try to do here on Benzinga is always try to show both sides of the coin, because we feel that truly that's what the investor is deserves, right? I mean, there's too many times where certain medias have a tendency of focusing on one side of the coin when really what we're here to do is present information for investors. And I feel like that's what truly you guys do. Yes, it's on the sell side, of course, and you guys look at short reports, but truly what you're trying to do is bring transparency inside investor space, right? And
That's
especially
right.
retail investors that a lot of times get misled by companies. And I think that that's truly what you're here. Is that what the mission is behind at Spruce Point Capital?
That's absolutely right. Look, what makes a market are buyers and sellers, and we believe strongly that only generally one side of the story is being told, and that's the side that the companies want you to hear, and that's what they want to sell you on, and that's what the mainstream media, wants you to buy into. But we definitely believe there's a lack of voices on the sell side and giving alternative views as to what is actually happening and what might be going behind the scenes at the companies that you aren't hearing about in the mainstream media. And we're doing that by obviously digging deep into the financials and reading footnotes, looking at the accounting assumptions behind presentation, doing background checks on management, talking to people in the industry or former employees, doing all that old-fashioned work that is a lost art.
Definitely. And I would say that, one of the things that I hear of negativity towards short reports is that they don't do the due diligence. Now, that's one thing that I could definitely say from going through multiple reports that Spruce Point Capital has put out. There's a lot of due diligence there. And you'll see from their expansive reports that they put out, it's not just, a letter out to investors. No, it's a big presentation. So if you haven't seen some of their reports before, I definitely recommend you guys get over to the website and just work through some of these. And we're going to be talking about some of the home runs that you guys have had in the last year or two. But let's first get into the new update from WD-40 that you just recently put out.
Yeah, so that's a classic example of a company most people know, right? You probably have one in your closet, a little blue and yellow can that's a lubricant that you spray on things when your door is locked or some latch gets stuck. And just because a company, you're familiar with the brand, doesn't mean it's a great investment. And we've done a lot of work on WD-40. We think that they're suffering from some longer term challenges. Number one is electrification of vehicles and bicycles. New electric motors have fewer moving parts. Electric bikes have fewer moving parts. So the less mechanics that go into a device, the less need for lubrication. And so that we think is a big long-term trend moving against them, number one. Number two, they don't have a proprietary product. So while you think that WD-40 has something special, they really don't. They have a formula that they don't make public, but that doesn't mean other companies can't make lubricants and sell it, at prices 50% less than WD-40. So if you go into the dollar store, you'll see the WD-40, but you'll see a house brand which functions very similar at 30-40% less. So we think they're very challenged. We've criticized the management for not being as transparent about what's going on in their various end markets. Both the CFO and CEO have recently, quote unquote, retired. We're calling on the new management to kind of reset some aggressive expectations on the revenue side. They chose not to, but really where the rubber hits the road is the earnings or the lack of earnings. And you'll see, if you look very carefully, for this past year, they have a $2+ billion market cap, and they generated $2 million of cash flow. And that just doesn't cover their capital spending. It doesn't cover their dividend, and it doesn't cover their stock buyback. So that means this company is going more and more into debt just to take money from creditors and give it to the shareholders. And that, to us, is a very nonsensical policy. It's not sustainable. And as a result, we think the stock has more downside, downwards to below $100. We find it to be very overvalued at 3 to 4 times revenues. A company like this with no moat, with limited growth, should be trading at 2 times revenues. And if you believe that multiple, we still see another 50 plus points of downside.
So let's go to the next up here, MGPI or MGP ingredients. Let's talk about that. It seems like this is a transformation story gone wrong. Tell us about the company and where they're failing to meet some expectations.
Yeah, so this is the one we were on a long time ago. They bought an old liquor distillery in Indiana, and they got lucky. They bought it distressed in 2009, for $20-30 million. And look, we had a big whiskey boom and a liquor boom over the past decade, and they benefited from that. But in all markets where supply and demand are in balance, eventually profits bring supply and demand back in balance, and so that those profits from the distillery business have sort of petered out. And they've always talked about wanting to transform into a branded liquor company. So before, they would make the whiskey and then sell it to a marketer. So you go into the store, you see a liquor bottle, maybe it's like, I don't know, the Bullet brand or Hell's Angel or whatever the case. It's not actually, that company might not actually be making that liquor. It might be MGP making the liquor, selling it to the marketer, who then puts it in the bottle on the label and sells it to you. And that was a good business for a while, but they've always wanted to get into the branded business and sell their own branded products. And so, this was their final transformation. In April of 2021, they announced a merger with a company called Luxco that had its own brands, some premium brands. And every time we look at a company doing a transaction, we want to see what is management saying they're going to accomplish, and then what is actually happening. Okay, and so we're now over 18 months, past this merger, and we find some troubling things. Number one, the company said the gross margins for the business would expand. Well, actually, they've gone down. Number two, they said that the merger would be immediately cash flow accretive. And in fact, the opposite's happening. The cash flow's gone down, and we're finding that the company's making restatements to their discussion about cash flow and whether or not Luxco was included when they merged. So, this has us really concerned that if you can't trust the numbers, like, how do you put a value on it? And what we see is that since the merger, the valuation of the company and the stock price have expanded, but yet the company hasn't delivered on what they said they were going to deliver, and now they're making restatements to cash flow. So we have real problems there. And we covered this company a number of years ago. We're a little early, but we got it correctly. The stock went down about 50%. The former CEO and the CFO left the company. Now they have a new management, and we see the same story again. Stock's back at 100. We think it could easily fall, 35%.
Yeah, I think this is important. One of the things that I see you guys calling out here is the trend, right? And then on Spruce Point arguing that the grand ambitions are starting to fall, right? I mean, one of the things is when these trends seem to change, right? It seems like there's a lot of times these kind of, I would call them the late majority to the trend. And being part of that late majority ends up failing on you because you have this big outlook that the trend's going to continue going. And that's the actual end of the trend, which just gets you caught in a lot of investments that they probably don't want to be in.
Right. Yeah. And just one final point on MGP, and this is just a very simple point, but the liquor business is incredibly competitive. When you walk into the liquor store, you're seeing, end of aisle promotions. Companies are fighting for shelf space to get your eyeballs directly at your eye level. To succeed in this industry, you really have to spend a lot on marketing and advertising and promotion. Okay. And if you look at the big companies, Constellation Brands, you look at Anheuser-Busch's, you look at Brown-Forman, which has a bunch of whiskey brands. These guys are spending anywhere 10 to 17, 18% of revenue, okay, to market their products. And MGP is spending 3% of their revenue, okay? And so we just don't see how they're going to succeed in the branded liquor space when they're vastly underspending. I mean, they spent about $16 million on advertising and promotion next year. Even if they were to double it, okay, their earnings would vanish. So we don't see how they are going to succeed with such a limited spend. It's going to be very hard for them to grow.
All right, now let's have this is where I think we have a little bit of fun. And let's talk about some of the ones that you guys have hit some home runs with, because I think this is an important thing to look back on, right? And so the first one on my list was one that really caught my attention when they first came out. And it just seemed like everybody was definitely hyped up. And a lot of times that's what we're going to see with a lot of these companies that are mentioned for the home runs. A lot of hype behind these companies, but just didn't find the hype. Let's first one up is going to be Oatly Group.
Okay.
This was an interesting one. This one you guys actually called out around when it was around $20, and now look where it's at. We're at 197 there. So what do you think about the Oatly Group now?
Well, full disclosure, we're no longer short it. We covered it probably a little bit too early, but having said that, we shorted it at an incredibly attractive prices when it was in the high teens, even over $20 a share. It was just something that seemed so ridiculous at the time to think that, an oat milk company could have a $15 billion valuation and losing money. I mean, again, at the end of the day, as we talked about with liquor being a competitive business, oat milk is a business that has no barriers to entry. I mean, you can make it at home from oats and water, right? You can make your own oat milk. So, and anybody can do that, right? So, there are certain businesses and industries that are just inherently more susceptible to being good shorts. Food products is one of them because number one, consumer preferences change. But number two, whenever a new trend happens, all the competitors jump in and, generally just shift their production process to meet the new demand. So we had soy milk, we had almond milk, and then oat milk became popular. And so, anyone who could make almond or soy, quickly converts over to oat milk. And before you know it, you got 10, 20 guys in the oat milk space. And then they're all, again, trying to promote their product to get, shelf space, to get eyeballs. And, guys like Oatly are up against big competitors, like Chobani. You guys know that, they have great yogurt brands, and you'd buy a pack of yogurt, open it up, and they'd be promoting their oat milk. And so, it's a tough industry to succeed. And then Oatly also got caught in the commodity squeeze, with oats and rapeseed oils and all other inputs going up, and they didn't have the ability to pass on prices that quickly. So the margins got crushed, and the stock, went down, and now it's, probably at a little bit more reasonable level. But I think still there's an open-ended question: will this company ever make money? There's a possibility they never make money. There's a possibility the stock goes to zero. But at this point, the risk reward is less favorable when you're shorting something in the high teens. Is shorting a sub $2 stock. Anything can sort of happen, and we've seen cases in the food business of irrational buyers. So who knows? Maybe Pepsi and their Quaker Oats wants to get into oat milk, and now they can buy Oatly on the cheap. I'm just speculating, but my point is, it's just, it's a little bit less of a favorable risk reward here.
Definitely the hype came down. And the next one that I'd give you is Generac. They recently came out with their guidance cut already getting hit. But I think your guidance was a little bit earlier than their guidance there. Talk about what you're seeing recently in Generac.
Yes, that thesis is playing out. It's a company that we felt was very highly promotional. You type in Generac and CNBC or Fox Business News, and the CEOs all over the place talking about, potential, climate disasters and grid, grid issues that they're going to solve with new acquisitions. And, their core business is home standby generators. And one of our concerns was that that's a maturing category. And now all of a sudden they pivoted with some acquisitions into the clean energy space. Why? Because, they get a higher multiple for entering some faster growth, more ESG friendly areas. And, but you always have to look at, like, again, what are the companies saying and what's management doing? We started to see the CEO create a family foundation, start to sell, stock under 2 stock sale programs. And we started to see some stress in the numbers with payables, growing really fast and working capital starting to get strained. And so we started to caution investors, hey, look, maybe this story is not as rosy as you might, be hearing from the mainstream media and from the CEO. And, sure enough, they ended up getting into a little fracas with one of their distributors, which filed a lawsuit against it, which we believed, was going to eliminate potentially $100 million of sales. And, the company just came out last week admitting as such that they were having problems and dramatically cut their guidance. And that caused a big revision in the stock price. So, again, it's buyer beware. Make sure you always question what management's saying when you see a CEO, out promoting so heavily. Look, we think good CEOs should be, working on operations, building the business, spend a small amount of time on marketing, not, all the time on marketing. And so, that really got us interested in Jazz for Generac as a short.
All right, now go to one more here. I'll bring in Porch because I feel like this was one that a lot of people had a big outlook for. I mean, this was supposed to be the everything business model, right? I mean, you guys can take a look at it. It seems like it's been parked on the porch. It seems like it because down now towards $1.40. Porch Group.
Yeah, I mean, again, full disclosure, we're no longer shorted. It's just not an attractive risk reward at the moment. But yeah, it's a great example of so why were we interested in Porch? Number one was the CEO. Okay, he had come from a company called Active Networks, which a number of years ago I co-authored a report pointing out some problems with that business. It was a roll-up business, some aggressive accounting. That stock, the management ultimately came clean, reset the guidance. Stock went down a lot, was eventually taken private. But, the CEO of Porch came from Active Network. We saw them doing a lot of acquisitions, which we didn't think makes sense. It was a SPAC, obviously, which, we were doing a lot more due diligence on lower quality businesses, not making money, coming public through SPAC. And, ultimately Porch hasn't made money. They've continued to acquire. They still don't have a path to profitability. And in this business now, in this market environment, you have to have a path to profitability. Otherwise, the market's just not going to buy into the story. So, yeah, that was a good one, as well. But we should save the last for what we still are short. You should ask me what we're really excited about coming forward.
That's exactly what we're going to be getting into. So I wanted to definitely give those outlooks on some older reports. And also first, let me throw in here, I'm going to throw in the link for you guys to check out all the research that Spruce Point Capital points out. And so I definitely want you guys to go ahead and check out. And you guys can see also how they've done in the past. Check out some of these reports, see what they talked about, see how they came into play, what worked, what didn't. I think this is the important part of also learning from this experience. But what's next, Ben? What are you looking at?
So if you go to our website, you'll see in July we put out a report on Skechers. Raise your hand if you know.
The sketch.
Raise your hand if you know the Skechers, the shoe company.
Yeah.
Well, most people are familiar with it. And of course, again, getting back to WD-40, you know the brand, you possibly trust the brand, but do you know the actual company, and do you know the people behind it, and do you know what's going on with the financials? And, we warned about Skechers. Number one, they have, dual class share structure, and, we believe the governance could be better, giving shareholders more of a vote and say in the company. They're being advised by someone with an SEC record, that had worked at LA Gear being an old shoe company that came under SEC scrutiny a number of years ago. But look, why are we jazzed? I think there's no question that when we put our first recommendation back in July, I think the stock was about 38. So the trade's in the money and stock's down 4 points. But why we're really jazzed is we're playing for the next 20% down, the next $8 to $10 down, and the company's going to report earnings soon. And if you follow the shoe and the shoe industry, you'll see that guys like Nike and Adidas are out there warning very, very carefully about consumer slowdown and about inventory not flowing through, and about ultimately margin pressure. And and part of our report, Skechers has pretty decent exposure to China. And late last week, Adidas came out and warned about slowing sales in China. And so that's a big part of the Skechers story is China. Which we think is going to disappoint. If you look very carefully at Skechers inventory, it's extremely elevated. We noted this in our report. On the last call, management said it was repositioning inventory, which to us means inventory is not selling at certain locations. It's being moved around. But we think the company's stuck with a lot of inventory. We think that the revenue expectations haven't yet come down for next year. So if you look very carefully at the revenue estimates for 2023, the analysts haven't revised them at all, and yet analysts are revising, Nike's numbers down and Adidas numbers down. And ultimately, look, we think they're stuck with too much inventory. We think the revenue numbers have to come down. And we note that twice in Skechers' recent past, they've had inventory corrections where when they finally come out and tell investors that there's too much inventory and take markdowns, the stock has gone down, 15, 20, 25% on that news. So there's a chance it happens this quarter or next quarter. They're going to report this week. We'll see what they have to say. But all the data points in the sneaker industry, if you believe that Nike and Adidas, two global brands, are good bellwethers for the sneaker business, I'd be very cautious on Skechers into earnings here.
Yeah, definitely. And when we start thinking about it playing also into the China, we just seen China stocks getting crushed today. It just goes to show us that the demand in China is definitely not where it needs to be. Well, thank you, like always, Ben Axler, joining me. We'll definitely have you back on anytime that you want to come on. The floor is yours, my friend.
I love it. Thank you very much, Money Mitch. You guys keep up the good mission. I think you're doing the right thing, giving the short sellers a voice. We need more of it. We need more players like Benzinga and Money Mitch out there.
Always here for you, Ben, and have a great one. Spruce Point Capital. I threw up those links. I want you guys to check out the research. And like I said, always do the due diligence yourself. What did they get right? What did they get wrong? And what's to come are great questions to be asking. Have a great one, Ben.
Take care.